Over the past decade and a half, the financial markets have experienced a period of relative ease. The S&P 500 earnings have roughly doubled and the price has tripled, while the highest federal funds rate was just 2.5%. This has made it easy for businesses to expand and for investors to make money. At the end of 2019, you could have bought almost any stock and realized nice gains in the financial markets as the COVID-19 pandemic caused widespread chaos and businesses shut down. Despite the turmoil, the central banks of the world stepped in to prop up the economy by printing trillions of dollars and giving it to businesses and consumers. However, with inflation now at 40 years high, the strategy of printing money to save the economy is no longer effective. The Federal Reserve has been raising interest rates, restricting access to money, and putting the brakes on the economy. This has caused the financial markets to experience frustration. Cryptocurrencies have plunged. Realty is falling. Big-name firms are struggling, and the stock exchange is looking unstable. Investors are selling with fears that the deep economic downturn is here. Regardless of the challenges encountered by the monetary markets, this could actually be the very best time of your life to build your riches. In this video, we will discover why this is such a large event and just how can you use it to your benefit. Investing involves a significant amount of psychology, more than people are aware of. The basic concept of investing is to purchase at a low price and sell at a high price. But in reality, most people do the opposite. They purchase at a high price and then sell it at a low price. This is not intentional, but fear, uncertainty, and doubt during challenging times can cause them to exit the market. However, as seasoned investors like Warren Buffett, Charlie Munger, Manish Paparai, Guy Spear, and Philton would attest, a heavily declining market presents the best opportunity to invest. The lower the cost of entry, the better the potential returns. The phenomenon of inverted investment psychology is fascinating, and the root cause is often a lack of clear investment goals and short-term mindset. When negative news and a recession arise, rather than capitalizing on the opportunity, many individuals shy away from the potential short-term discomfort. However, this approach is misguided and not an effective strategy in the long run. Check this graph that showcases the history of the U.S. bull and bear market since 1926. Blue indicates bull markets, orange represents bear markets, and gray bars depict recessions. From 1926 to present day, there have been 15 recessions and 11 bear markets. That becomes 12 with the inclusion of the 2020 drop. The total duration of bear markets was 15 years, compared to a bull market span of 75 years. Consider this. These intimidating and seemingly catastrophic events occur infrequently. As depicted, those with the courage to invest during these challenging times are often rewarded greatly. Consider the returns following the Great Depression. An impressive 265% return was made over a 4.4-year period after the next bear market, followed by a 43% return in 1.8 years, 210% in 4.1 years, and a whooping 908% over 14.8 years. This trend continues. I'm particularly fond of the chart included in the Tony Robbins book Unshakable. If you had the foresight to invest at the bottom of each of the major bear markets in the recent history, your 12-month returns would have been 20%, 30%, 40%, and 50%. While it's impossible to accurately predict the exact market bottom, it's crucial to acknowledge the immense opportunity that a bear market can provide. For example, if an investor had made a decision to invest at the peak of the market prior to the COVID-19 induced market drop in 2020, their return would have been around 9%. However, if the same investor chose to invest a few weeks later, when the market hit its low, their returns would have been around 60%, a sustainable difference in a short span of time. This highlights the importance of carefully considering the timing of investments, as the entry points can significantly impact the outcome. To be a successful investor, it's crucial to stay informed and then execute your investment strategy with precision. There are two popular approaches to long-term investing: dollar cost averaging and Warren Buffett's value investing. Dollar cost averaging is a popular choice among investors as it eliminates the emotional aspect of investing by spreading the money across the stock market via a market tracking investment such as an index fund like the classic S&P 500 index fund. This strategy involves investing a setup amount into the market tracking investment at regular intervals, say $3,000 every 6 months. This way, your investment is spread across the whole market, eliminating the need to worry about specific investments and annual reports. Although dollar cost averaging may not seem like you're timing the market and take advantage of opportunities during a stock market crash, it actually is. When the stock market is high, $2,000 may not buy as many shares, but during a market crash, the same amount will purchase more shares. On October 9, 2007, $2,000 bought 12.78 SPI shares. But a year later, during the market's plummet, $2,000 bought 20.5 shares. Dollar cost averaging is a strategic approach for the passive investors to take advantage of the opportunities that arise from the market crashes. It involves consistently investing, with the result of purchasing more shares when prices are low and fewer when prices are high. However, some investors prefer to have more hands-on approach with their portfolios and adopt a Warren Buffett-style approach, where they select individual companies that they understand, have a competitive edge, strong management teams, and are available at a margin of safety prices. Currently, the main problem that businesses are facing are high inflation and rising interest rates, which make costs higher, debt more expensive to service, and consumers spending less. To be confident that a business can cope with the environment, it's essential to consider the following factors when choosing companies to invest in. Pricing power. The business should have established a dominant position in the market, allowing them to increase prices without experiencing a decrease in sales. For instance, Coca-Cola holds such a strong competitive advantage that they can raise prices while still seeing an 8% increase in drink sales and a 4% rise in concentrate sales. This feature is essential for success during inflationary times. Debt levels. To ensure that a business can handle increasing interest rates, it's crucial to maintain low debt levels. Companies such as Google have a strong financial standing, with more cash than debt and a debt-to-equity ratio of 0.05. Companies like Meta have no debt, making it nearly impossible for them to fail. Business model. When evaluating a company, it's crucial to consider if its business model is resilient during economic instability. For instance, during recessions, grocery stores often perform well as people continue to require basic necessities. On the other hand, travel companies may experience difficulty as rising interest rates limit consumer spending. It's essential to evaluate the company's ability to maintain its revenue stream and profitability during different economic conditions. For passive investors, the best approach is to keep on investing as usual and stay strong and go long. Active investors, on the other hand, should consider the business model, pricing power, and debt levels of the companies they invest in. Recessions present big opportunities for investors, and by considering these factors, active investors can be confident that they won't get hurt during these times. Thank you for watching. Please like and subscribe.